Hey, hello, folks. Welcome to Pro Trader Strategies. My name's Eric Wilkinson, and this is Spotting the Trade. We're going to get you folks what you need to know before you roll, and that's going to start out with talking about the economic data, see how that impacts the overall markets with some market analysis, maybe sprinkle in some geopolitical fodder to round that all off, and then talk about some option strategies that we've been implementing into my portfolio based on those assumptions that I come up with this directional assumption. So without further ado, let's get on with the economic data. It is Unenjoyment Friday. That's something we would call on the floor is the first Friday of the month. Why? Because we get the unemployment data. And one of the things that we look for in the unemployment data is the average hourly earnings and the unemployment rate. That's one of the headline numbers that we look at. Something to see there, the unemployment rate came in at 5. Oh, that's Canadian. Sorry, my bad. It was like 5.2%. That's Canadian. It was in line with expectations. Here in the United States, ours came in at 3.6%, upticking from 3.5%. So what does that mean? Unemployment rate starting to ratchet up. And we're in an economy where everybody seems to be talking about the overall economy is looking pretty good. It's strong. We're just looking for folks to work. Well, we're seeing the unemployment rate uptick. That's a little bit bizarre. Well, non-farm payroll change came in at 428,000, expected to be 390,000. That is hires. That's folks getting jobs. All right. So what it looks like is happening here is with the overall interest rates starting to rise, looks like a little bit of that money that the government was pushing out during the pandemic. Well, that money probably is starting to dry up there for those folks that received that. And now they're starting to look for a job. Right. That means I'm going out. Maybe I was a discouraged worker. We talked about just this, I think yesterday. Discouraged workers fall off of the statistical data set, right? If I'm not looking for a job, I'm not actively out there trying to get a job, well, then I fall off the unemployment rate. I fall off the non-farm payroll number, all of that, because I've stopped looking for a job. I can't claim unemployment or any of those things, so I don't become a statistical average. Now, if I start coming back into the workforce, start looking for a job, well, now I come back into that data set. I become part of it. And if I'm looking for a job, that seems to make that will make the unemployment rate start to jack up because I come back into the system. All right. So that's kind of what we're starting to see right now. I think that's actually a good thing to start seeing these folks kind of get off the porch and start looking again. And that's going to start really helping out economies of scale here, because we talked about this just yesterday, wage inflation, right? We saw wage pressures driving higher. I said the only way to really see this start to dip a little bit would be to have a fresh, well, not in so many words, but a fresh round of new workers come into the workforce to try and help bring down that wage inflation, because we've been talking about this since the pandemic. Those folks that went back to, say, the restaurant industry, being a waiter or a waitress, those folks had a lot of hours and were making some really good money because nobody else was coming into the workforce at that point in time. So they got all the hours. A lot of that paradigm starting to shift there. Maybe we will see some of this wage inflationary pressures ebb a little bit. And then later on today, we've got a lot of Fed governors speaking. Remember, we just had the Fed meeting. Now they're allowed to start talking about what they see in the economy. There's a little bit of a shutdown right before the FOMC meeting that they can't really talk about the economy so much in policy. So we're going to see a lot of that coming out of these Fed members now that they are able to talk now. All right, crude oil starting to cruise a little bit higher unexpectedly, really, because we're seeing some strength in the overall economy. One of the real draggers on this economy is inflation, and some of that has to do with wage inflation. I know smaller businesses are really struggling with that right now. That hopefully will help ebb some of that. Bonds continuing to move higher here. Short-term interest rates jacking up a little bit more than longer-term interest rates, despite the fact that we're seeing bonds fall here. Now, remember, they're inversely related. As bonds start to sell off, that means that interest rates start to jack up. All right. So as we're seeing the price fall here in bonds, we know interest rates are going higher. They're going higher in the nearer term than the longer term, though. And that is a bit of a warning sign for folks that are trading that there is some recessionary factors in the future here. All right, gold just not responding like we would expect here. Yesterday, we saw a cash grab again, whether it was gold, Bitcoin, or VIX spiking higher because equities were selling off. Complete reversal from the previous day. And again, a cash grab. Like I said earlier on, tech probably going to be one of the first to start showing this weakness. Then folks would start to look to roll over to the Dow Jones Industrial Average. Now, if we roll out of one stock and into a new stock and market still continues to sell, well, that is what we call the weak hands. Those folks will dump those stocks as soon as they start seeing losses. That'll exacerbate us to the downside. It doesn't even seem like we would see that normal rotation where all of these equities are selling off, and then we got to put our money somewhere to work, right? And you would expect gold to be getting that boost. In this day and age, you would expect the Bitcoin to get that kind of boost. Not happening right now. It is a full-on cash grab, and folks are willing to lose. What is it? We saw interest rates, or inflation somewhere upwards of between 4 and 7% for whoever's talking about it. Well, if you're doing a cash grab and you're holding on to that, you're losing 4 to 7% every year to inflation. So folks are saying, making this decision, they know, hey, if I put it here, it's probably not going to be worth as much next year, but I probably am not going to lose as much in the markets as I would to inflation, is what it's feeling like folks are thinking right now. And as you can see, yesterday I talked about this. Don't get in too quickly on the buy side here. We are not done working out through this inventory because volumes just really haven't been there. And if we don't have volume, there's just no follow through. And that's kind of what we're getting with these markets, just these juking and jiving all over the place lately. One thing I want to talk about here is not Scott's, but I want to talk about Lulu. Or I don't even want to talk about Lulu. I want to talk about let's talk about Lyft for a second, because this is the one that I took a trade on here to the downside. Remember, right after the earnings, took this trade, wanted to see some volatility sell off. As a matter of fact, I did a webinar yesterday on selling some puts in an environment where we want to add some underlyings to our portfolio. Well, when we're selling puts, we're getting another 10% drop basically in the market from where we currently are to start adding underlyings to our portfolio. I think that's a pretty good spot to start at least dipping our toes in, to start adding some equities to our portfolio. And with Lyft, I talked about this. I don't think they're really going anywhere. Yes, they are continuing to lose money here. Maybe not as much as one was expecting, but it is still losing money. That was the overarching theme, I think, with some of these stocks. If they've lost money in the past and they're continuing to lose money now, with this type of environment, those multiples that we've talked about, remember we're talking about multiples on multiples, going out and trying to figure out pricing based on that. Well, those multiples really aren't looking so rosy right now. And that's why we're really getting this pullback here across the board. But with this said, I put an order in there to try and cover this yesterday. It didn't get hit. I was working a 10-cent bid. Sold the 17 and a half puts in there right after the earnings. Still had high volatility. Knew that the market was finding a bottom. I got a little bit lucky because Uber came out with really good earnings and forward guidance. So that gave a little bit of a boost here to Lyft as well. So those May 17 and a half puts I sold for 51 cents. We showed on this pullback and the volatility coming out how all those levers and pulleys work yesterday in that video. So please check that out. I don't have the time to give it the justice that I did yesterday, but I do expect a little bit of upward momentum for this type of name and volatility to kind of subside a little bit. So with that said, those May 17 and a half puts I sold for 51 cents. I'm trying to get out for 10 cents. I've got a GTC in there to keep working that. I came really close yesterday to 11 cents and never quite got to my mark, but I'm going to continue to work to get out of this one and see what we can do. But other than that, with the market volatility right now, I'm going to need to find a serious bottom here. And as you've seen with me talking through these daily market commentaries, I'm not really completely sure that we found that bottom, because I've got a couple of points, lines in the sand, if you will, that I think we have to go and hit those targets first. All right. So have a great weekend. Be careful today, because going into a weekend, the unknown, folks really don't like to hold a lot of risk. All right. So be careful, stay safe. And if you can't take that, take it easy. Hey, don't forget to smash that like button before you go, bro. Bye now.